Okay, good morning, everyone. Good morning, everyone. I welcome you all to today's training session on financial planning and bookkeeping. You're all welcome to today's training session on financial planning and bookkeeping. My name is Oheru Chechuku, so I will be the facilitator for today's class. I want to believe that everyone can hear me. Can you all hear me? Okay, I want to believe that you all can hear me. So let's start off by looking at what we mean by financial planning. At the end of today's training session, it's expected that you, the participants, should be able to, one, understand financial planning activities, two, differentiate long-term financial plans from short-term financial plans, understand the reasons for bookkeeping, the reasons why financial record keeping is so important, identifying also bookkeeping methods available to you as business owners. Also, you should be able to know the basis of accounting available to you for your record keeping. Then you should be able to record financial transactions. And we'll try to balance our books. But this class is basically on financial planning and bookkeeping. So even if we are not able to balance the books, no problem. The emphasis here is for us to know how to maintain our financial records, which is bookkeeping, and how to plan our finances. That borders on financial planning. Because I know some of us or most of us may not have accounting background or knowledge. As such, the training session will only be restricted to financial planning and bookkeeping. So every other accounting processes will have to be put on hold. So let me start this morning by telling you this saying that you can't run a healthy, successful business without having your books in order. It's not possible for you to run a healthy and a successful business if you do not have your financial records in order, that's in place. Any attempt to do that is like driving a car without a fuel gauge. And when you drive a car without a fuel gauge, you know what is likely to happen. Your fuel will run out and the car will automatically stop. And the car will be forced to be pushed or towed aside. So the same thing, I want to liken this scenario to running a business without having financial records. So if you don't have a financial record and you don't plan your finances, it's like driving a car without a fuel gauge, where any moment in time you discover that the car will stop. And the car symbolizes the business, meaning if you don't maintain your financial records and you don't plan your finances, the business is likely not to go far. Nobody prays for that. So that's the whole essence of today's training session, so that we can see how to plan our finances. That borders on financial planning. So why financial planning? Financial planning is a plan needed for estimating the fund requirements of a business and also deciding the sources of the same. So we are saying that the whole act of planning our finances is what we call financial planning. You plan finances by ascertaining how much fund requirement you need for you to establish that business of your choice. You know that you want to go into business, you want to set up the business, but it is also very important for you to establish how much in terms of naira and kobo, that's the fund requirement, that you need for injection into the business, for the business to operate efficiently and effectively. So first, identifying the fund requirement for the business. Then financial planning also borders on the sources of funding. Having identified that X amount of naira is needed for the business to be set up, you need to also establish where the money will be gotten from. That's the sources. The question of where should the funds be gotten from? Should the funds be taken from friends and associates? Should the funds be contributed by the shareholders? Or should the funds be gotten from any money markets, such as NISAL microfinance bank? So taking all of these decisions or making decisions that border on the sources of these funds, how much is being needed, and when they are being needed, all of it borders on what we call financial planning activities. So first, you have to identify how much is needed for the business to thrive. And secondly, where the money will be gotten from. That's the sources. And thirdly, when the money will be needed for injection into the business. So all of these activities is what financial planning activity seeks to address. So financial planning, it essentially includes generating a financial blueprint for companies' future activities. So the whole act of generating a financial blueprint for your company to operate is what we refer to as financial planning activities. So here are some of the objectives or importance of financial planning, the main reasons why companies, entrepreneurs like you plan their finances or engage in financial planning activities is one, to ensure availability of funds. To ensure availability of funds. So when you plan your finances, you are making sure that funds are available for that intended. That's the primary objective of financial planning. Secondly, estimating the time and source of funds. So to estimate the time and the source of funds, you need to plan your finances. It's not just enough for you to estimate that the availability of funds needed for the business is X amount of naira. Maybe you need 10 million naira for the business. That's the funds that you require. But it's also very important that you estimate where the funds should be gotten from. That is the source of the funds. And the timing that the funds will be needed. No rational investor will want to take up funds either through borrowing, what we call debt. Nobody will want to take up borrowing. You borrow funds and you start paying interest on the funds when they are not needed. So the timing has to be right, ensuring that funds are borrowed only when they are immediately needed. So that's what we mean by timing. The timing has to be right. Then sources of funds. Management also, the shareholders, the owners of the company have to also decide on which sources of funds, where to take the funds, that especially the interest rate, or what we call the finance cost, will be put at the barest minimum. If you want to take up funds now, one of the things or criteria you may have to consider will be where to source those funds at the lowest minimum interest rates. Those are considerations for you, the entrepreneurs, to make. So all of these borders on financial planning activities, estimating the time and the source of the funds that is needed for the business. Also, generating capital structure for the business. So another financial planning activities that you may consider under this topic. Generating capital structure. When we say generating capital structure, we are saying that the total fund requirement for a business should be split between equity and debt. So split of your total fund requirement between equity and debt. What is equity and what is debt? Equity is the total fund contribution by the owners of the company. That's the shareholders. Whatever amount the shareholders bring or inject into the business is what we refer to as equity. So if you, the business owner, a couple of other shareholders who have floated this company, dip hands into your pocket to contribute funds for the business to thrive, whatever amount you have contributed is called equity. Then whatever portion that is borrowed either from NISA Microfinance Bank or any money market is referred to as a debt. So splitting your total fund requirement between equity, that's the one contributed by shareholders, and debt, the one being borrowed, is what we refer to as capital structure, a company's capital structure. So the capital structure of every company has to be right. Because if your capital structure is not well deliberated upon, you may decide that a company may be trading excessively on borrowing, on debts. And no company will want to trade excessively on debts because there are implications. When you have your total fund requirement constituted majorly by debts, there are implications that debtors may run after you for repayment of principal and interest at any time. Creditors may run after you for insolvency. Creditors may chase after you for bankruptcy. So these are the risks why the capital structure has to be balanced, ensuring that at least equity contribution by owners of the business is more than whatever amount that is being borrowed. So this is what we mean by generating a capital structure for the company. And lastly, avoiding unnecessary funds. This is connected to the timing of the funds. You have to make sure that the timing of the funds is very right. Because when the timing is very right, you discover that you are able to minimize what we call borrowing cost. Interest charges are kept at minimum. It makes no sense for you to take up funds. Like I said earlier, you have borrowed funds from NISA Microfinance Bank or whatever the finance institution is, and the funds are not immediately needed. You will only bear what we call finance cost on those funds you have borrowed. So you have to gauge it such that when the loans are being taken up, when the money is being borrowed, you can now start paying interest. Essence here is to eliminate interest payment before the business commences operation. So that's what we mean by avoiding unnecessary funds, because every fund that is injected into every business, you discover there is a cost of capital attached to it. Even if it is the fund you, the business owners, the shareholders are bringing on the table for this business to thrive, there is also a cost of borrowing attached to it, because you, the shareholders, would have as well invested the funds in other money market or short-term investments to earn your returns. So there's always a cost attached to every fund being injected into the business. So these are some of the objectives of financial planning that you may want to consider while planning your finances. So financial plans are categorized broadly into two. We have the long-term strategic financial plans and the short-term financial plans. So let's start from the long-term strategic financial plans. Long-term financial plans consider a number of financial activities which include but are not limited to: one, proposed fixed asset investments. Proposed fixed assets investments. Let me give you an instance. If your company is proposing on how to finance its fixed assets, what are those fixed? What is even fixed assets? Fixed assets are those items that belong to a company which is expected to live beyond one accounting period, one accounting year. So your fixed asset for your business could be your motor vehicle, because those are the items that the business entity has, which it uses for revenue generation. And those assets are expected to live beyond one accounting year. So motor vehicle, your motor vehicle is an example of fixed assets. If you're involved in farming, your tractor is also an example of fixed assets. Your computer laptops, your laptops, desktops, printers, office building, if you have any, those are your fixed assets. So if management is considering on how any of the fixed assets should be purchased or how fixed assets are to be financed, those activities border on what we call long-term strategic financial plans. Let me give you an instance. Let me tailor it to a specific example. You are involved in farming and management is interested in procuring a tractor for the farming business. So the moment management is considering decisions such as how these tractors should be acquired, management has various options available to them. You have an option of buying the tractor outrightly. That is if you have the cash available. You can procure the tractor immediately by paying for it. You go to any distributor and you pay for it. Management also has another option of financing this tractor or acquiring this tractor through what we call hire purchase. Some people call it finance lease. So these are the options available to management. So as management is trying to take decisions that border on how to finance these proposed fixed asset investments, such decisions, such plans, such activity is what we refer to as long-term financial plans. So long-term financial plans also consider another activities on that borders on research and development. Research and development activities. Activities aimed at developing or promoting a company's product or prototype. So when management is concerned with activities or plans that will help promote its products or services in the long run, those research and development activities fall under what we call long-term financial plans. Marketing and product development, on how the products of the entity are to be developed. Capital structure also is another activities under the long-term financial plans. Deciding on the capital structure. I've explained what this capital structure is. Deciding on what proportion of the total fund requirement will be contributed by the shareholders, referred to as equity participants, and what proportion of the total fund requirement will be borrowed, will be loaned from finance institution. So, like I said earlier, if you know you need 10 million for injection into the business, so taking decisions to determine how much out of this 10 million will have to be contributed by you, the shareholders. You are the equity participants, and what portion of it will have to be borrowed. Out of the 10 million, management will say, okay, we have 6 million to bring, to contribute as shareholders, while the 4 million to make it 10 million will have to be borrowed, either from National Microfinance Bank or any finance institution. So taking such decision is what we refer to as capital, deciding on the capital structure of the firm. And as you plan, as you make these plans or engage in this activity, they fall within the long-term financial plans. Also taking plans that borders on sources of financing, ascertaining where these funds will be gotten from. These fall under long-term financial plans. Should the funds be borrowed from friends and well-wishers? Can it be borrowed from any commercial bank? Should it be taken from any microfinance bank, such as National Microfinance Bank? Or should it be taken from African Development Bank? So all of these border on long-term financial planning activities. So these plans are generally supported by a series of annual budgets and profit plans, meaning in as much as a company may have what we call long-term financial plans, the long-term financial plans are further translated into annual plans. For you to know that a plan is of a long-term financial plan, such plan must cover activity that border on 3 years period. If you have a plan that covers activities for 3 years and above, you know that such plan is a long-term financial plan. Meaning that long-term financial plans cover a longer period of time. They tend to address activities or issues for the company for a period up to 3 years and above. So this is what we mean by long-term financial plans. So if a plan is not a long-term financial plan, it is definitely a short-term financial plan. So let's look at the short-term financial plans. Short-term financial plans specify short-term financial actions and the anticipated impact of those actions. And typically they cover 1 to 2 operating period, 1 to 2 year operating period. So just like the name suggests, short-term financial plans are meant to address short-term financial activities. A good example of those short-term financial activities could be management of your working capital. What are those working capital? Any item within the company which can either be translated to cash within 12 months. A good example is your inventory. Some people will call it stock. So taking decisions on how your stocks are to be managed, those are short-term financial plans. Also taking decisions on how your receivables, another name for receivables is debtors, how your debtors are to be managed. As you make those plans, as you take those decisions, we say you are taking short-term financial plans. Management may decide, oh, for receivables, once we sell on credit, giving rise to debtors, those who are owning the company. Debtors can only enjoy 1 month credit period, meaning that all sales are expected to be settled within 1 month at most. So such decisions border on what we call short-term financial plans. So a key distinguishing factor of short-term financial plans from long-term financial plans is the period that the both cover. For a long-term financial plan, we say that the period is usually of a longer period, of a longer time, 3 years and above. But once it is short-term financial plans, you consider activities that border within 1 to 2 years. That's another way of distinguishing whether a plan is a short-term or a long-term strategic financial plans. So in a bid to carry out your financial planning activities, you may need certain tools used for planning. Certain tools are very, very crucial for
your planning activity, for your financial planning activity. And one of the key tools needed is what we call cash budget. Cash budget is a very useful tool for planning your finances. So what is a cash budget? Cash budget is a statement of a firm's planned inflows and outflows of cash. When you have a statement that outlines, that shows how much a firm intends to generate as cash inflow and how much that same company intends to incur as an expenditure, all of them aggregated and put into a statement. That statement is what we refer to as a cash budget. So when you prepare a cash budget, it's expected that the cash budget will show the various sources that you are likely to generate your revenue for the period. The cash budget. It will also show you all the areas, likely expenditure heads that you are to incur for the same financial period. So a cash budget itemizes all the inflows and the outflows. So it is used to estimate short-term cash requirements with particular attention to anticipated cash surpluses or shortfall. When we prepare cash flow statements, emphasis is on ascertaining if the business or if the company is liquid enough or not. So the essence of drawing up a cash budget is to estimate how liquid the company is. Liquidity of a company translates to ability of that company to settle short-term debts when they fall due. So if your short-term debt, maybe those people, your vendors who have supplied goods to you on credit, who have supplied raw materials to you on credit, maybe vendor has supplied fertilizers to you for your farming season. So if the vendor comes asking for repayment of the amount due to them, and you are able to quickly pay that amount without any hesitation, it means your company is highly liquid. You have cash available at your disposal to settle those debts when they arise. For a company that is not liquid will struggle to settle the short-term debt when they arise. Why? Because there is no cash and cash equivalent available for the company to dip hands into and settle all its liability. So a rational business investor like you will always strive to have what we call a surplus cash budget. Your budget, you will strive to always have it in surplus. For you to have a surplus cash budget, it means all the total inflow is more than all the total outflow, meaning that all the amount you have generated for the business is more than what you have spent to leave you with some cash and cash equivalent available at your disposal to settle debts when they fall due. So that's what we mean by having a surplus cash budget. So typically monthly budgets are developed covering a 1 year period, a 1 year time period. So in as much as budgets are prepared annually, before you start the year, you say, okay, this is my budget for the year 2020. Like some of you will have budget. You say, okay, this budget, even before the salary comes, you've already drawn up budget for it. You say, okay, I want to cook a pot of soup. What's this amount of naira? I want to buy jewelry. I want to buy a wrapper. I want to buy a pair of shoes. The same thing applies to your business. It's expected that your income and your expenditures will have to be budgeted. You should be able to project to say, oh, in this coming financial year, I expect to earn income or revenue or sales from this, and these customers. And also, in order for me to earn those revenue, I also expect to incur expenses in this, and these areas. So what you have done is that you have drawn up a cash budget for the financial year. And let us also not forget that cash budget, just like the name suggests, is only based on plans. You plan, but after the financial year, maybe at the end of the year 2020, you discover that the plan you have made which is the cash budget, may slightly or greatly differ from the actual results. It may be that you have planned that in this financial year, I want to generate a total revenue of 20 million. And maybe after the year, you're able to generate 25 million or even 30 million. You may plan that your expenditure for the year maximally should not exceed 8 million. But after the year, you discover that your expenditure may fall below the 8 million. But the essence of planning cash budget is to ensure that at least the firm has what we call surplus cash at its disposal. But in a bid to having a surplus cash to meet your short-term debts when they fall due, it's also advised that you don't hold unnecessary cash. It makes no sense for you to hold unnecessary cash. Like some people will have cash lying in their bank account. It makes no sense. Those cash should be either invested in a short-term investment that earns you return, no matter how little it is, instead of having the funds lying idle. But as you are embarking on this investment, short-term investment, it's also expected that you are very, very liquid. At least you should have some within your disposal. Even if they're into investment, you should be able to liquidate that investment and settle short-term investment, short-term debt when they fall due. Okay, so here is a typical budgeting cycle. Budgeting cycle follows these steps and processes. Number one, you have to identify what we call performance planning. You have to plan your performances in budgeting. What do we mean by performance planning? Performance planning is simply setting a goal or objective for the business. So when you set up the goal, you say, okay, this is my goal for this financial year. Like some people will say, okay, this financial year, because I'm involved in farming, I want my output. Take, for instance, I have 5 hectares of land. It's okay. After the farming season, I want to at least have 10 tons of maize from these 5 hectares of land. So the 10 tons is the objective, the goal of the business for that farming period. So first, there has to be performance planning. In other words, there has to be a goal. You set a goal. It's only when you set a goal, you are able to drive processes towards achieving that goal. So for the instance I've just given, I want at the end of the farming season to have at least 10 tons of maize from the 5 hectares I've cultivated. That is my goal for the farming season. Then you move on to the next one under the budgeting cycle, which is providing a frame of reference. There has to be a benchmark. You benchmark your goals. It will be totally unrealistic when you provide goals that are not reasonable. For instance, I've said, okay, I want my output to be at least 10 tons from the 5 hectares of farmland I want to cultivate. Meaning that a realistic frame of reference or benchmark is that on average, 1 hectare of land should yield at least 2 tons. That's a realistic frame benchmark that I have set. So the benchmark has to be right. Otherwise, at the end, you discover that your budgeting, your results will differ greatly from whatever plans you have carried out. The third one is investigating variations. After implementations, you investigate variations. So when you plan, you discover that the results may be different from whatever plan that you have embarked upon. And if the results are different from the plans you have drawn up before in your budget, you may want to investigate variations. Like the scenario I gave you, I want at least to have 10 tons of maize after the farming season from the 5 hectares of land I've cultivated. So if for any reason I have, say, 7 tons of maize from the 5 hectares I have cultivated, you mean the 7 ton You see now that the 7 ton is different from the 10 tons, which I had already set as my goal and my objective. So the only thing I can do is I will investigate the variation. Why is there a variation of 3 tons? Why is it that my output was not up to the benchmark, the initial goal I have set? So I investigate variations. Part of investigating variations, I may want to probe into, would it be that I didn't plant early enough that resulted to the low yield output? Would it be that I used a wrong input in my planting and farming season? Maybe the fertilizers I used were not of good quality. The grain, the maize that I used as seedlings were not of good quality. So these are the investigations you have to launch when there is a variation, especially when the plan or when the budget didn't go as planned. Then the next step is launch a corrective action. You have to launch a corrective action to ensure that at least you forestall the reoccurrence of whatever that happened, especially when the result is adverse. Result is adverse if it greatly falls short of your expectation, short of your goal. Like I told you, I'm expecting to have at least 10 tons of maize, but I ended up having 7 tons of maize. You can see there's a variance there, a variation. So I need to correct that action. Part of the corrective action could be ensuring that planting is done a little bit earlier next farming season, ensuring that at least I use the right farm input, the fertilizers, the seedlings, and all that in the next farming season. These are some of the corrective actions I may have to embark upon. And ladies and gentlemen, you do what? You plan again. So budgeting is a continuous process. As you plan the first time, it's expected that you continue the planning. It's a continuous process. So having planned, having budgeted for the first time, whatever the result is, whether favorable or adverse, it's expected that you repeat the same planning process. But in this time, you should have taken corrective actions, and you should have also investigated into any variations that occurred. So here is strategy. Strategy is classified into 2. We have long-run strategy and short-run strategy. FM has long-run strategy and short-run strategy. So for you to achieve your long-run strategy, you need to use tools like long-run budget. I mean, your budget should cut across a longer period of time. Then if you want to address short-run strategy, it's also expected that you use short-run budgets to address the short-run strategy. So depending on what you intend to achieve, decide on which of the strategy to deploy and which of the budgets to also use. So cycle of money, that is what we call cycle of money. The primary function of finance is the movement of money from lenders to borrowers and back again. This is referred to as cycle of money. Every money that comes into the business tends to do what? To cycle within and outside the business. Every fund injected into the business tends to do what? To rotate. It rotates. Let me use that word. It rotates, cycles in and out of the business. Let me give you an instance. If we prove successful and the funds are handed over to us by National Microfinance Bank, the fund comes into the business. The fund comes into your business as an inflow. And the fund will find their way out again. By the time you start paying for salaries and wages, you start paying vendors who have supplied you with goods or services, depending on what the nature of your business is. You pay taxes and the rest. You pay salaries and wages. You pay vendors. You discover that that same money that came into your business as a loan or as your own personal contribution has found its way out again in settlement of wages and salaries and all your liabilities due to vendors. And even as the monies go out again as payment of salaries and wages and settlement of vendors, the money will still come back to the business again when you have eventually produced or manufactured your goods and services, and customers will pay for it. You discover that the money finds its way back to the business again. So all of this in and out of the fund, the money in and out of your business is what we call cycle of money. That's what we said. The primary function of finance is the movement of money from lenders to borrowers and back again to the company. So the money will still find its way into the business accounts, in and out. As it comes in, it goes out again. That's what we refer to as cycle of money. Now let's consider bookkeeping. Having talked about financial planning, don't forget we said today's session is on financial planning and bookkeeping. We have talked about financial planning. Now let's talk about bookkeeping. Bookkeeping involves the recording on a daily basis of a company's financial transactions. So the whole act of trying to document all your financial transactions on a daily basis is what we refer to as bookkeeping, meaning for every 1 naira, every naira and kobo that passes through the business, either is coming in or is leaving the business, you are providing a record for them. You are documenting it somewhere. That's what we mean by bookkeeping. Those are bookkeeping activities. You have a policy that, before money is passed, before money is paid to any vendor, you have to document it in your books. You have to key it into your system. That act is what we call bookkeeping activities. Those are bookkeeping activities. And like I told us earlier, if you do not have a proper bookkeeping activity for your business, you discover that you may be likened to that man who drives a car without a fuel gauge. At any moment, you discover that the fuel is finished and the car will be forced. The car will either be towed or be pushed aside. Meaning that bookkeeping is very important for every business to succeed. So with proper bookkeeping, ladies and gentlemen, companies are able to track all information on these books to make key operating, investing, and financing decisions. So once the books are there, you are able to take key operating, investing, and financing decisions as the decision makers. Bookkeepers are individuals who manage all financial data for companies. Without bookkeepers, companies would not be aware of their current financial position, as well as the transactions that occur within the company. We are saying that bookkeepers are those people who manage all financial data for companies. So if you have the funding to employ or to engage the services of a bookkeeper or account clerk, or even a qualified accountant, you are strongly advised to do so. But if you consider getting an accountant or a bookkeeper quite expensive, there are ways that you can maintain the books yourself, even as a non-accountant. So it's expected that before the end of this session, I will show you or teach you how to maintain your financial records, even as non-accountants. So here are the importance of bookkeeping. Here are some of the importance of bookkeeping. 1, bookkeeping provides a reliable measure of a company's performance. So adequate bookkeeping will provide a reliable measure of a company's performance. It's only when you maintain your financial record, you are able to ascertain if a company is making progress, improving in terms of profitability or not. That's what we mean by reliable measure of a company's performance. You're able to measure a company's performance to know if the company is performing well enough or not when you have books, adequate books in place. Another importance of bookkeeping is that it provides information for strategic decision. When you have proper books of account in place, you're able to take key strategic decisions as business owners. As a business owner that you are able to take key strategic decisions. Let me give you an instance. Maybe you're involved in farming and you have two segments. You have the crop cultivation segment and the animal cultivation segment. These are two segments. On one hand, you are cultivating crop. On the other hand, you are rearing animals. These are the two segments. So it's only when you have adequate books of accounts, your financial records are in place, that you can ascertain which of these two segments is making profit or not. Imagine if you're able to ascertain that the crop cultivation, crop farming is not bringing enough return. You are able, then you can take some key strategic decision by saying, oh, I want to close down this crop cultivation and channel all the energy and resources into the animal cultivation. These are key strategic decisions that you can make only when you have adequate bookkeeping in place. Then, providing benchmark for revenue and income goals. You're able to provide benchmark, you identify all the sources of revenue and income goals available to your business, and you go after them. Then fulfillment of legal and tax obligations. Adequate books of account will help you fulfill all your legal and tax obligations. Of course, you know, once the business is incorporated, you start operations, you commence business operations, it's expected that you pay taxes on your profits. So when you have adequate books of accounts, you maintain your bookkeeping, you are able to comply with these legal and tax obligations. Like I tell people, I say, okay, if your business is relatively new, within the first 3 years of its operation and the business records losses, it's expected that the business should be exempted from tax payment. That's a tax law. But when you don't maintain your financial records, you don't have books in place to justify that you have sustained losses for that accounting period, it becomes very difficult to convince the FIRS and the tax authorities that you have actually recorded losses, and as such, you should be exempted from tax payments. That's why your books have to be in place. Then bookkeeping provides stewardship to investors. In modern day business, you discover that investors are different from the managers. Investors are people like you who will provide this funding for the business to thrive, while the managers are those employees who are entrusted with the day-to-day administration of the business. So the only way the managers can provide stewardship and accountability function to you, the investor, is only when adequate books of accounts have been maintained. So that's why bookkeeping is so important. Then proper management of cash flows. When you keep your books of accounts, you are able to properly manage your cash flows. You're able to manage your cash flows. Okay, let's consider what we call accounting basis. Accounting basis. There are basically two bases of accounting. We have the cash basis and accrual basis. Let's look at the cash basis first. Under the cash basis of accounting transactions are recorded only when cash is actually received or paid. So if you have adopted the cash basis of accounting for your business, it means you only record transactions, accounting transactions, only when cash has been received or paid by your company. Take, for instance, you have just sold your goods on credit to a customer, and the customer is promising to make payment in 1 month's time. For the fact that you have adopted or chosen the cash basis of accounting, it means the sales transaction, you can only record it. You can only book that sales transaction to have occurred only in 1 month's time when the money has been received from the customer. That's the cash basis. Transactions are not recorded except there is a flow of money, except cash exchanges hands. It's only when the cash exchanges hands that you can now record that transaction. Even if the customer has to owe you for 6 months, you will not recognize that sales transaction until in that 6 months time when you have received such money from the customer before you can now document the sales transaction. That's a cash basis. Also, I give you another instance. You have made purchases from your vendor, your supplier. The supplier has supplied you with one of your raw materials you need, maybe bags of fertilizer for your farming. And you are promising to pay the vendor in 2 weeks' time. For the fact that you have not paid your vendor, you cannot record that purchase transaction. You cannot say you have purchased fertilizers. It's only in 2 weeks' time when you have paid the supplier either cash or check, meaning that money has exchanged hands, that you can now book that accounting transaction. So under the cash basis of accounting, that's why we say transactions are only recorded when cash is actually received or paid. The moment cash exchanges hands, you book the transaction. But if cash has not moved in or out of the business, you consider that transaction never to have occurred. Then the second one is the accrual basis. Under the accrual basis of accounting, transactions are recorded when they occur, even if cash is not received or paid. So you record these transactions only when they occur, irrespective of the fact that cash has not been received or paid. From the illustration I gave you before, I said you have supplied your goods to a customer. You have made sales on credit. Even if the amount is due for collection in 1 month's time, the fact remains that that sales transaction has occurred as we speak. It has occurred because you have allowed the customer rights to the possession of your goods, meaning that the transaction has occurred. So even if you have not received the full value for such sales transaction, according to the accrual basis in accounting, you are expected to record that accounting transactions. You document it in your books. The same thing applies to the purchases. The purchases, I gave you an instance. You have bought goods on credit from your customers, and you are promising to pay in 2 weeks' time. Even if payment has not been made, for the fact that you have taken deliveries of those goods that your vendor, your customer has supplied you, you have now become indebted to the customer, meaning that the transaction has occurred. And as such, you are to record the transaction under the accrual basis. So the distinguishing factor between the two is that under the cash basis, emphasis is on cash movements. It's only when cash moves, you record the transaction. Either cash comes in or cash leaves the business, you record the transaction that resulted to that cash movement. But under the accrual basis, as long as the transaction occurs, even if cash has not been received or paid, you are expected to record that transaction. So the question now is, which among these two is most suitable for us as business owners in keeping our books? The accrual basis is most suitable for accounting purposes. You are strongly advised to use the accrual basis, because the accrual basis aligns with the economic reality. Let me give you an instance. Imagine if you're a supplier and you supply goods to government, any of the government agencies. You supply goods in the year, this year, 2020, and you know government is unpredictable. You cannot tell for sure when you are to receive the payment. Imagine if you don't get payment in the year 2020 that the supply is made, and you are eventually paid in the year 2021. Are we then saying the year 2020 that the supply was made, even as cash has not been received, that revenue for the year should be zero? The answer is no. the transaction has occurred. Because any attempt to book revenue as zero, and don't forget you have incurred cost to supply those goods, meaning that your cost, your expenses have gone up while revenue is zero. Anybody that looks at your financial records or the account you have prepared for that year that the supply was made, we tend to think that you have sustained losses, not knowing that part of your funds are being tied up as a result of the supply you have made. So that's why we said accrual basis is most suitable. Like under the accrual basis, even if you have made supplies to government, you discover all you need to do is you accrue for that revenue. You book it as receivable. It's shown there that yes, at least you have made the revenue, even if it has not been received, but it is showing as accrued income that somebody is owing you. So the accrual basis is more suitable and more realistic than the cash basis. Take note. Now, it's also very important that you know that any of these accounting basis that is adopted will have to be applied consistently. If you choose to use the cash basis, it's expected that year in, year out, you should apply the cash basis. You don't use the cash basis this year, and next year you want to use the accrual basis. Switch between accounting basis is totally prohibited. If you decide to use the accrual basis, it's expected that year in, year out, 2020 that the business commenced, you have used accrual basis. 2021 is expected that you use accrual basis. 2022 continue in that same manner with the accrual basis. The essence is to allow financial statements to be comparable, because if you use cash basis in the year 2020 and 2021, you use accrual basis, you discover that the financial statement, the two financial statement becomes incomparable. You're not able to compare the financial statement for the two. So here's an example before us. You purchase 100 units of a product and you will pay for it next month. You have made purchases of 100 units of a product and you will pay for it next month. So under the cash basis of accounting, because payment is due next month, and we said for cash basis, emphasis is on what? Cash movement. For the fact that cash has not exchanged hands, you are expected not to record any transaction. Under the accrual basis, even if cash has not been paid for the goods, 100 units of product that has been supplied to you, but the fact that you have taken deliveries of those products, we say that that transaction has occurred, and as such, you should record that accounting transaction. You go ahead and record that accounting transaction. So take note the difference between the cash basis of accounting and the accrual basis of accounting. Here are the methods of bookkeeping. Here are the methods of bookkeeping. We have basically two methods of bookkeeping. Recall at the beginning of this session, I told us that at the end of this section, it's expected that even those without any prior knowledge of accounting will be taught how to maintain their financial records, how to keep books of account. Yes, non-accountants can use this single entry bookkeeping for maintaining their financial records. How does it work? Single entry bookkeeping is a straightforward method where one entry is made for each transaction in the books. So if you are using the single entry bookkeeping, you are basically documenting every accounting transaction that happens. The customer pays for goods, you open a book for it. Maybe you have a hard column cash book where you document, you create a particular section or column for recording all the sales transactions that you have made. You can have another section for recording all expenditures. So, okay, I made repairs today. You record it in that same book you have created. You paid salaries today. You record it in that same book you have created. all of them under different columns, depending on the nature of the expenditure. These are simplified ways of keeping your financial record. Another person also who operates with check, who uses check as an instrument for making payments, the person may want to fill out the check stubs. The small leaf after you have turned the check, the small leaf on that check booklet, you see some people putting the narration to clearly show what that payment relates to. That is another form of what? Bookkeeping on its own. So you have to devise which one is most suitable to you. And for the single entry bookkeeping, we said it is what? Straightforward. Even non-accountants can even use this method. Some people will just walk into a bookstore and say, okay, give me, there's what we call analysis column cash book. You get the analysis column cash book that has various columns. You say, okay, this column, I want to record all sales transactions that happen during the year. This column, I want to record all salaries and wages I make. This column, I want to record all diesel and fuel I buy. This column, I want to record all repair expenses I make. This column, I want to record all utilities, such as cable, TV, water utilities, and all that. So these are simplified ways of keeping records, even as a non-accountant. That's for the single entry bookkeeping. Then we'll move on to the double entry bookkeeping. Double entry bookkeeping will appeal mainly to accountants, those people with accounting knowledge. So if you're able to afford the services of an account clerk or a bookkeeper or a qualified accountant, it's expected that they maintain the books using the double entry bookkeeping. So under the double entry bookkeeping, it is more robust. It follows the principle that every transaction affects at least two accounts, and they are recorded as debits and credits. So for every transaction, they are recorded as debit and credit. That's for accountant to say for every debit transaction, there must be a corresponding credit transaction for accountants. But if you are not an accountant or you don't have any knowledge of accounting, you're expected to stick to the single entry bookkeeping method. So here is an example before us. For example, if you sell a bag of cowpea for 20,000 naira, the entries that will be required are you debit the bank account depending on how the money was paid. If you received it through cash, you debit cash. If it was paid into your bank account, you debit bank account and you credit sales account. But like I said, I'm not going to bore you with the whole act of debit and credit because majority of us may not have this accounting background. So it's advised that if you don't have the accounting background, you stick to the single entry bookkeeping methods. Don't forget, the whole essence of this bookkeeping is to help you produce or generate what we call financial reports. As you maintain these financial records, this bookkeeping activity, either in your analysis column cash book or the hardcover notebook you have maintained, the end product of that bookkeeping activity is for any qualified accountant to pick up whatever record you have kept and produce what we call financial reports from it. For the act of bookkeeping, you as the entrepreneur, you as a business owner, you as non-accountant, you can also keep your books of accounts. Okay, so accounting systems. There's what we call accounting systems. Accounting systems are designed to collect, document, and report on financial transactions affecting business. Any system whatsoever that you as a business owner have designed to help you collect, document, and report on financial transactions affecting business. That is referred to as accounting system. For instance, the whole act of setting up the analysis column cash book that you record all your transactions That is referred to as accounting system. It means you are setting up your accounting system. So accounting systems are categorized into two. We have the manual accounting system and the computerized accounting system. For the manual accounting system, accounting transactions are simply processed by hand. If for any reason you process your accounting transactions by hand, it means you are using the manual accounting system, like the one we just discussed, where you have to record the transaction on a analysis column cash book, hardcover notebook, or you record it on your check stub when you issue checks. These are all manual accounting systems because you maintain the account, you have designed such system such that the accounting transactions will be processed by hands. But this other one is computerized accounting system. If for any reason financial information is recorded by entering it into a computer, it therefore means that you are using the computerized accounting system. Like some people will say, oh, install Excel sheet for me, spreadsheet, install Excel for me, such that whenever any transaction happens within the business, be it sales, be it expenditure, whatever it is, you go to the Excel sheet and you record that transaction on the appropriate column. For the fact that you are using computer to maintain your account, it means you are using a computerized accounting system. Some other persons will say, oh, because we want to minimize error, quickly install accounting software for us. It's okay, install Sage, install Peachtree, install Tally, install QuickBooks, and all that. So any of them to use any of these accounting software or spreadsheet, Excel, as it's popular called, it means you are maintaining your accounting system using the computerized system. So I want you to know the two types of accounting system, which is manual and computerized, and the difference between the two of them. Now, even as accounting transactions, accounting systems are maintained through computer, that's a computerized accounting system, there is also what we call GIGO, garbage in, garbage out, GIGO. The fact that accounting transactions are maintained with the use of computer, it doesn't preclude such financial report from error. Your accounting transactions, your financial report may still have some error even while you use computer. Yes, no doubt, computer can be more reliable, more accurate than the manual accounting system, no doubt about it. But as far as GIGO is concerned, garbage in, garbage out, if you mistakenly, you the bookkeeper, mistakenly key in a wrong information into the system, you can be rest assured that even the financial report, the end product of the bookkeeping activity will also be inaccurate. It will be inaccurate. So that's why we must make sure that the information we feed into the system is accurate to a large extent. I give you an instance, somebody who, even as you say, okay, systems are more reliable and accounts that is supposed to be debited is now credited, and the one that is supposed to be credited is now debited. You discover that the whole, even the accounting system, the accounting report, when generated, when produced, will contain some form of error. That's GIGO for you. So still on the accounting system, there's what we call generally accepted accounting principles. Generally accepted accounting principles, GAAP, as it's fondly called, GAAP. All accountants use the same set of rules to prepare financial reports. The same set of rules guide accountants while preparing financial statements. The same set of rules. And this set of rules are issued by Financial Reporting Council of Nigeria, FRCN. It is the FRCN that issues this set of rules that guide accountants in preparation and presentation of their financial statements. Let me give you an instance. If there is no common acceptable accounting principles to guide accountants and bookkeepers in preparing and presenting their financial statements, you know what will happen? Some business owners like you may want to present the accounts in such a way that profits for the year may be very little. Why? Because they don't want to pay taxes. So that's why we said the generally accepted accounting principles must be strictly followed. Because whatever financial report you produce, there are various users of financial information that will rely on that information you are producing, that account you are producing. Another preparer of financial statements may want to manipulate the profits such that profit after tax or profit before tax is so high. Imagine a manager that you have promised that his compensation will be incentive-based. You say, okay, your profit is a function of how much profitability, your reward system, is a function of how much profitability you're able to make for the company. The manager will do whatever possible to ensure that at least the profit is reasonable enough so that he or she can enjoy the benefits that has been promised. So in a bid to curtail all of these window dressing and creative accounting while preparing financial statements, that's why the FRCN, Financial Reporting Council of Nigeria, came up with this set of rules known as GAP, such that everybody will abide by the provisions of these generally accepted accounting principles. Because when we prepare accounts, when we maintain accounting records, we are not maintaining it to suit the need of a particular user. There are various users of accounting information. I'll tell you who the users are, ranging from the internal users and external users. So it's expected that every form of financial report that is produced will have to be objective, fairly represented, faithful representation. You state it as it is, not trying to do what? To manipulate the figures. That's why we must abide by the rules and provisions of generally accepted accounting principles. So financial reports summarize information about the financial status of a business. So ladies and gentlemen, the end product of the bookkeeping activities that I want you to maintain is for you to be able to generate your financial reports. The end product of that notebook that you document all your accounting transactions is to enable qualified accountants to be able to generate your financial reports thereof. So that's the end product, financial reports. The end product of bookkeeping is what? Generating financial reports. That's why accounting is called the language of business, because it is so fundamental to the communication of financial information. Accounting is often called the language of business because it records all transactions involving Naira and Kobo that passes through the business. So here are broad categories of accounting reports. Accounting reports are categorized broadly into reporting information to external users. So if you, as a business owner, produces any accounts that will have to leave the business to be studied by those we call external users or to be used by external users, that report, financial report you have produced is referred to as financial accounting. So simply put, financial accounting is meant for presentation to who? External users, those who are not members of the company. But any account that is prepared, accounting report that is prepared solely for internal use, solely for internal users' consumption, who are internal users, the shareholders, the managers, the employees, and the rest. I will tell you the categories of external and internal users. So the ones that is meant for internal consumption within the company, we refer to it as management accounting. So management accounting focuses on reporting information to management, that's owners of the company, often referred to as accounting for internal users of accounting information. Management accounting. So your accounting reports may be prepared for external use, and if that happens, it means it is financial accounting, or it may be prepared for internal use. In that case, we call it management accounting. So like I told you, here are the categories of examples of internal users and external users. So external users are individuals outside the business who have an interest in the business. So anybody outside the business, or in one way or the other, has interest in your financial reports, that person is referred to as external user. A good example of them is government. Under government, you see regulatory authority, maybe the agency that regulates your business operation. Imagine if you are into insurance now, insurance business, you have to submit your accounts to who? NICOM, National Insurance Commission. If you provide financial services like the banks, you have to submit your accounts to who? CBN, Central Bank of Nigeria. Your account to prepare. A government agency known as FIRS, Federal Inland Revenue, may be interested in that account you have produced. Why? Because they want to assess you on tax. So government is an external user. Another category of external user is general public. The general public. But your financial statement can only be made public if you are a PLC, if your company is a PLC. The likes of Julius Berger PLC, Dangote PLC, Zenith Bank PLC, GT Bank PLC, and the rest, because these are public companies, their financial statement is always available. You go to internet, you see the annual reports, PLCs. And civil societies also are categories of external users. Civil society group may be interested in your financial reports, depending on your activities. Then lenders, those who have provided you with funding. Example, NISA Microfinance Bank. If eventually you get this loan from NISA Microfinance Bank, NISA Microfinance Bank becomes your lender. And because they are your lender, they can at any moment call to see your financial reports. Then internal users are individuals inside the business. Example, the shareholders. We all know who shareholders are, owners of the business, like you, who have brought in your hard-earned money, resources and energy, time to do what? To float this business, the shareholders. Shareholders will be interested in the financial reports. The internal users, the managers, those you entrust with the day-to-day administration of your business. They will also be interested in the financial reports when they are ready. The employees, if you have staff, the staff will be interested in seeing your financial reports. So these are the categories of external users and external users. Internal users and external users. So, like I told us, the end product of the bookkeeping activity that we maintain is for us to be able to produce accounting reports. When you maintain your books, it's expected that you are able to produce your accounting reports. So those accounting reports that can be generated from the bookkeeping activity range from what we call balance sheets, meaning the hard cover notebook that you have booked in all your transactions for a particular period, or the spreadsheets, that's the Excel, the computer software, you have booked in your accounting transactions. It's expected that you should be able to produce any or all of these accounting reports. Number one being the balance sheet. So balance sheet is a statement that is prepared to show what a business owns and what the business owes to third parties and outsiders. So balance sheet categorizes what a business entity has, what belongs to a business entity, and what the business entity is owing to third parties. So I'll show you a format of a balance sheet. So when preparing balance sheet, it's expected that at least your assets must equal your equities and liabilities. In other words, once we add equities and liabilities together, it should give you the exact value of the company's assets. Then the second statement to be generated from your bookkeeping activity is income statement. Income statement is a statement that is prepared to show how much profitability in terms of profit or loss that a company has made in a particular period. So when you want to know how much profit you have made in a particular period, it's most advisable that you generate income statements. And in preparing income statement, you simply say sales minus expenses. It gives you profit or loss. Then the third one is cash flow statement. Cash flow statement is a statement that is prepared by a company in order to assess its liquidity position. So cash flow statement is basically to show how liquid the company is. And remember, I explained what liquidity means the other time to us. Ability to meet a short-term debt when they fall due. If you're able to meet your short-term debt when they fall due, it means you are liquid. The company is liquid. The company has enough resources, cash and its equivalent at its disposal at any given point in time to meet up with debts when they fall due. So that's a cash flow statement. So basically, in preparing cash flow statement, you aggregate all the total cash you received in a particular period and less all the total cash expenditures you have made for the same period. So it will leave you with either surplus or deficit. Like I told us earlier, a rational business investor like you will always strive to have a surplus cash flow statement, meaning that all you have generated, that's all the inflow, exceeds all the outflows. So this is a simple balance sheet. Like I was trying to explain balance sheet equation to us. With balance sheet, the liability and equity put together must equal the assets. Liability and equity put together of a company must equal the assets. What this simply means is that if we say a company's asset is worth 10 million, meaning all the items that a company has, that's the asset, is worth 10 million. It means that this 10 million would have been either financed through equity, that's through contribution by you, the shareholders, or through debt, which is liability. So liability and equity put together gives us the total value of assets. So for revenue, like I told us, when you aggregate all the revenue minus expenditure. So let's see, this is a format, a simple format of a balance sheet. This is a simple format of a balance sheet. You see in this balance sheet, you have assets and assets on left column, assets on the left-hand side, then liabilities and equity on the right-hand side. So for the assets, assets are further categorized into current assets and non-current assets. What are current assets? anything. Remember we said item is anything belonging to the company. So anything belonging to the company which can be converted easily to cash within 12 months will come under current assets. So if the company has anything that it can easily convert or translate to cash within 12 months, they will be categorized under current assets. A good example, cash and cash equivalent is already in this liquid form. You don't need any form of conversion. Accounts receivables are debtors. Those people you have sold on credit to that are now owing the company. It's an asset. And because they are owing your company, we expect them to pay within the next 12 months. That's why we categorize them under current assets. Inventory, also known as stocks. Any item that is held for resale by a company is referred to as stock. So if you have any stock, any item that you hold solely for the purpose of sale, because you expect the sale transaction to happen within the next 12 months, you categorize it under current asset. Prepaid expenses, payment in advance represents prepaid expenses. You have paid for services, but you have not yet enjoyed those services. A good example, some people may pay for 2 years office rent. After year 1, you have to prepare your accounts, meaning you have enjoyed the value for the first year rent. The value of the second year rent, which you have not enjoyed, will come under the prepaid expenses. If you have short-term investments that can be translated to cash within 12 months, all of them will be classified as current assets. Then for the non-current assets, those items or resources belonging to a company which assists in revenue generation for the company but cannot be translated to cash within 12 months. A good example is property, plant, and equipment. Under property, plant, and equipment, you have land and building. Perhaps your company has its building, its land. For the fact that the building and the land is expected to live beyond one accounting period, you classify it under non-current assets. If you also have office equipment, like maybe your laptops, your chairs, and the rest, for the fact that you expect to use those chairs, those computers, and the likes for a period over 12 months, they should be classified as non-current assets. You have motor vehicle as well. For the fact that the motor vehicle is expected to live beyond 12 months, that's one accounting period, they will all come under non-current assets. Then we have another one called intangible assets. Intangible assets are identifiable non-monetary items without physical substance. What do I mean by this jargon? If you have any item that helps your business in generating revenue, which cannot be seen, felt, or touched, we call such asset as intangible assets. You have something you have paid for, it helps you to generate, to make money for the business, but you cannot see it, you cannot feel it, you cannot touch it. We call it intangible asset. Example is license. Perhaps you have a fishing license to fish in a river. You are paid for that fishing license. You cannot see, feel, or touch it, but it helps you with revenue generation. So it will be classified as intangible assets. So that's for the asset side. Let's look at the liabilities and equities. Under the liabilities are further classified into current liabilities and non-current liabilities. When we talk of liabilities, we are talking of all balances due to third parties, all the amounts that the company is owing outsiders. That's what we refer to as liability. Remember, we said assets. Those things, those assets, those items that belongs to the business is what we refer to as assets. And when we come to liability, those balances, amount that is due to third parties, meaning they don't belong to the business, but rather it is the company that is owing externals, third parties. They are called liabilities. So any indebtedness of the company to third parties that is due for settlement within 12 months will be classified as current liability. Example, accounts payables. If a customer supplies you an item and you are owing the customer, that's accounts payable. We call them trade creditors. Creditors, you are owing a customer. And for the fact that you are owing that customer and the customer is expected that you settle what you are owing within the next 12 months, you classify it under current liability. Notes payable. Maybe you have loans and the amount for settlement is due within the next 12 months. You classify it as current liability. Accrued expenses. Perhaps you have enjoyed the goods or services, but you have not paid for it. Maybe you are owing taxes, you put it under accrued expenses. Maybe you are owing salaries or wages, you also put it under accrued expenses. Deferred revenue. Deferred revenue, when you receive payments for goods or services you have not supplied or rendered, that's referred to as deferred revenue. It's a liability to you. A customer pays you, but you have not discharged your own part of the agreement. That amount is treated as deferred revenue under current liability. Then the non-current liability, any indebtedness of your company that is due for settlement after 1 year will come under non-current liabilities. Example of non-current liabilities, if you're able to get this nicer microfinance loan, for the fact that the loan is repayable over a period above 1 year, that amount will be classified as non-current liability because you are not expected to settle the amount within 1 year. You're going to settle the amount over a year period. That's why you classify it as non-current liability. Then for the shareholders or equities, under equities, all balances belonging to the shareholders, equity participants. Example is ordinary share capital. Ordinary share capital belonging to shareholders. Anything equity is what belongs to the shareholders. Ordinary share capital, all accumulated profit or retained profit over the years. These are all shareholders' equity fund. Okay, before I go, you notice that the left-hand side, the left column and the right column, they are all equal. You see the total for the left-hand side and the right-hand side, you see that they are all equal, meaning that your balance sheet must always be equal. The two sides must agree. Now, here's this format of income statement. You see the income statement. What you can notice is that we see the sales. Under the sales, we see all the account balances that resulted to the sales. Meaning, if you're involved in various activities, it's also expected that you state those activities that resulted to the sales. Like I told you, you're involved into farming. You farm pig, you farm cow, you farm goats. It's expected that you state the revenue from each of these line item. You say revenue from pig cultivation, revenue from goat cultivation, revenue from chicken cultivation, and the rest. So you have to break it down among the sources of revenue for the period. Then the expenses you aggregate it. So total sales minus total expenditures, you have profit before tax. And you make provision for tax. You have profit after tax. So if you notice, you will see that the current year, which is 2004, the most recent year, 2004, is included on this statement, together with the prior year, last year, 2003. The essence of including prior year together with the current year is to help or enable users of financial information make adequate, informed decision. Like if you look at this statement now, you may be interested in saying, oh, revenue for last year was 302,000 total. This year it has grown up to 339,000, meaning that the company improved in its performance for the year. You also look at the profit and say, oh, profit for last year was 33,000, and this year it has grown to 41,000, indicating what? Growth or strength on the part of the witness. That's the essence of keeping prior year figures for comparability, to help users of financial information compare the financial statements of one period against the other. So here are the components of accounts, meaning for every account that you prepare, you are to have these components: assets, liabilities, and equity. So asset, liability, equity, the first three among the five, is components used for preparing the balance sheet. If you want to prepare the balance sheet, the components of balance sheet will be assets, liability, and equity. If you want to prepare the profit or loss account, the components of the profit or loss account, or income statement as it's fondly called, will be revenue and expenses. That's the last two. So no matter the account you prepare, the accounts will include some of these components, depending on whether it is assets, whether it is a balance sheet, or whether it is a income statement. Okay, so for the double entry accounting, like I said, I don't want to bore you with the double entry accounting. Why? Because some of us may not have the accounting knowledge, but it's expected that at least you should maintain your account, even if you are not using double entry accounting methods. Like I told you, at least you should use the single entry accounting method, where you just have a record that you book all your transactions. And remember, we said that one is simple and straightforward. You don't need to stress yourself, burden yourself as to which account is to be debited and which account is to be credited. But in any case, if you can afford the services of an account clerk or a qualified bookkeeper, you can do so. But in absence of that, maybe because you want to keep your cost at the barest minimum, you want to maintain your account yourself, it's advisable that at least you maintain the simple entry bookkeeping. Okay, so ladies and gentlemen, on this note, I would like to end the class, and I'll take questions from you. So the floor is open. We expect questions from you. Any question, any observation, any comments before we dish out our quiz? Okay, Mr. Daniel. Okay, go ahead, sir.
Yes. You did mention loan.
Mr. Daniel, we're struggling to hear you.
Long time is 2 years, 3 years.
We're struggling to hear you, Mr. Daniel.
Really?
Yes.
Can you hear me now?
Yes.
Can you hear me now?
Yes, go ahead, sir.
Okay. Now I want to take you on the long-term and short-term loan. Now, if a loan is short-term and it's between 1 year to 2 years, long-term is 2 years to 3 years. What about 6 to 7 years? How do you classify it?
What about what? 4 to 6 years, you said?
Yes, from 3 to 6 years or 7 years, as the case may be.
We're struggling to hear you, sir. Your network, I suggest, is bad. Maybe you have to drop it on the chat section.
Hello. Hello.
Mr. Daniel, can you send your question as a chat?
Okay, maybe let me
Or maybe you change venue.
I will.
Okay, please. Madam Ngozi.
Yes.
Very well.
Thank
Network is
you
okay.
very much
Very
for
well.
today's lecture. I will say that even those of us that didn't read accounting, we can as well say something about accounting. Thank you so much. My question is this. You taught us two bases of accounting, which you said cash basis and accrual.
Yes, ma'am.
So I want to find out. I notice both are good. Can one, a business, keeps the two, keep running the cash basis and also the accrual? Because what I mean is this: the cash always show you what comes in that you see. Then the accrual is, the ones that you feel they are money, but you have not gotten it. So I'm feeling that the cash will always let you quickly know what you have at hand. Maybe to launch out for someone that has more than one business to do another thing. And then from that cash, you'll be able to see what products that gives you more of those returns fast that you can launch out with. But another thing again is the accrual. You have some businesses you do on credit, hoping to get the money later. And if you begin to work on that, as in the bank statement, because I was trying to see the credit and the debit in the balance sheet, it will be difficult for someone that did not read accounting to understand that the money that is not at hand, but you're expecting, is part of
your revenue.
Revenue. So in order to, in a layman's language, can one now keep the two accounts, side by side? Maybe this one to really help you foresee what you have and can launch out for more business plans. Or what do you suggest?
Okay, I've had your question.
Thank you.
Is not possible for you to use the two bases of accounting simultaneously. Not possible. Yes, you can either use the accrual basis or you use the cash basis. As non-accountants, as somebody who does not understand the act of debit and credit, you can use the cash basis because that is the only one you understand. As the cash is moving, you know what to do, where the cash is going or where the cash is entering. Yes, the cash basis may be very easy for you to understand. But in actual sense, in real sense, and in more sophisticated businesses, the accrual basis is favored over the cash basis. Yes, it's favored over the. And I try to give you an instance. You have a contract. You have supplied the contract. Money has not come in by your customer, maybe federal government who is owing you. Should you now book a zero revenue for that year, knowing fully well that you have incurred the cost to enable you make supply of those goods? Any attempt to present the account like that, it looks as if you have done nothing for the year. In fact, you basically incurred cost without any commensurate revenue. Why the cash basis has some flaws. But if you are to use the accrual basis, yes, even as funds have not been received, you still go ahead and recognize revenue, receivable and revenue. Your debit receivable being an asset, showing that somebody is owing you, and your credit revenue. That's the debit and credit. But like I said, as non-accountant, you may have to rely on the cash basis. Trying to reconcile the two, even as you use the accrual basis to prepare your accounts, being favored, there is a particular statement that is expected that you prepare using the cash basis, and we call it cash flow statement. So even if you adopt the accrual basis to prepare your balance sheet, your income statement, it's expected that while preparing your cash flow, you should use the cash basis because cash flow captures all cash that is received for the period and all cash that is paid for the period to enable you see clearly how much cash you have, how much funding you have available. Because we may book receivable and claim, oh, this person is owing us and all that. But when we go to bank accounts, there may be nothing there. So the only way to establish how liquid you are these funds available is to use the cash basis and prepare the cash flow statement. For the two, you cannot use the cash basis and accrual basis simultaneously. It's either you are applying the cash basis all through or you are using accrual basis all through, except for cash flow statement.
Thank you.
Hope I've been able to answer you.
Thank you very much. I actually asked a question for all of us. I know that I'll prefer the accrual basis, which I know I can keep. Yeah, thank you so much.
All right, thank you, man. So, Mr. Daniel Eki, let's test your network now. Okay, you sent a message. Let me see. Okay, how can one classify a loan of 3 to 7 years, short or long term? If I get your question, Mr. Daniel Eki, can I get a nod? That's what you're asking, isn't it? Okay, so if a loan is for a period of 3 to 4 years, such loan is a non-current liability item. Remember, we say any indebtedness of your company to third parties due for settlement a period after 1 year should go to non-current liability. So the loan will be categorized as non-current liability. But most time when we prepare this account, if you're able to estimate the amount of repayment, both principal and interest, that will be handed over to the lender, maybe a nicer microfinance bank, in the next 12 months, it's expected that you bring that amount to current liability. I give you an instance. If you have gotten a loan now of 10 million from nicer microfinance bank, and the repayment period is 7 years, once you're able to estimate how much you can pay back to nicer microfinance bank in the next 12 months, at the point of preparing your account, out of the 12 million, maybe you say, okay, in the next 12 months, I should pay 1.5. The 1.5 comes under current liability. And the balance of the 8.5 goes to non-current liability. Hope I've answered your question. Okay, any more questions? Any more questions? Okay, if there is none, I will quickly share the link for the post-lecture quiz. So you have 5 minutes because our time is fast spent. You have just 5 minutes to make attempts on this post-lecture quiz. So answer the quiz and return back your answers within the next 5 minutes. So your time starts now. It's expected that anytime around 12:23, we should end the class for today to allow us time for other things. So you will see the link on this group. You will see it on this Zoom platform and also on the WhatsApp group. So expect you to make attempts. What's the total number of participants here? We are about 16. You're not expected to leave. Please quickly answer the quiz question, submit your answers so that we can end the class for today. Somebody has left. Hmm? Wow. Somebody even got 100. This is the money section. Okay. Impressive. So you have 60 seconds to turn in your answers. You're expected to cross the T's and dot the I's. Some of you have turned in your answers and the performance is quite impressive. Some of you did well, better than you did before the lectures. But somebody is even telling me that it's called 100 over 100. Okay, congrats, keep it up. So this clearly shows that you understood what that was said today. I'm happy at least. It makes me a good teacher. So keep it up. Okay, so ladies and gentlemen, it's time. 5 minutes is gone. And on this note, it's expected that we end the class, so it can allow us time for other things. So same time tomorrow, we shall all converge for tomorrow's section. So on this note, I want to appreciate you for your attention, rapt attention, and for your participation. So we'll have a lovely day ahead. Bye for now.